payments like there's no tomorrow.
Hello everyone, welcome everyone after the break. Today we will continue our journey in pricing of mortgage contracts. Today we have a block number 2 where we will discuss 3 important elements. So the first one, which is super important, is the pricing of annuity mortgages. So those are the contracts, the mortgage contracts, where you don't have outstanding notional or outstanding notional is decreasing in time. This means you are performing some kind of repayment of your notional. And those mortgages are very popular because you have essentially fixed amount of money that you have to pay on a monthly basis. So this is attractive because you can essentially plan your yearly or monthly budget if you have an annuity mortgage. On the other hand, every time when you perform a payment, you also reduce the outstanding debt that you have. So this means at the end, when you finish your mortgage contract, then you have nothing to be paid back to a bank. So of course, that's typically the objective of having a mortgage. And then the second part, which I will cover today, is the prepayment determinants. So what are the factors that people typically look at when they perform prepayment? So this prepayment risk is the people will pay more money than their installment in order to reduce the outstanding notional of the mortgage. So those are two elements for today. The first one is the discussion about the mortgage of annuity type, and the second one we discuss what are the incentives, refinancing incentives for the clients, such that they would like to prepay, or it is rational for them to do the mortgage prepayment. Enjoy the course. A mortgage which allows for repayments is the so-called annuity mortgage. So if we look at the monthly installments, we don't have only the interest rate payment of the outstanding notional, but also we have possibility of repayments. So this is we denoted by letter Q. So every monthly payment will consist of 2 elements: interest rate payment of the outstanding notional and contractual repayment schedule. So if you look at the contract in a bullet type of mortgage, contract didn't say anything about possibility of repayments. We could have, of course, prepayments, but those are limited by law to a certain degree. In an annuity, we have a schedule where we will reduce our outstanding notional. The whole idea of the annuity is that the monthly payments will be fixed over the lifetime of the contract. So this essentially the CTI is chosen in a way that we will reduce our notional such that the last payment, after the last payment, there will be no outstanding notional anymore. So this means that initially we will pay both interest rate and also notional, and we will define this CTI such that there is nothing more to be paid at the end of the mortgage. So in a bullet type, the last payment we had to pay essentially everything, the whole notional. In an annuity type, we don't have this case because we just schedule the repayments in a way that the notional will reduce to such degree that the last payment will cover the whole outstanding notional of the contract. So as you can see, this is much more popular and also much more accepted type of mortgage worldwide. So if we look at the definition or the amortization of our notional, so we have a notional at time ti plus 1. It's equal to the notional at the previous payment minus, and then we have this accruing period delta ti, which is defined as the difference between ti plus 1 and ti, and then we multiply with a qti. So the repayment that we have done at time ti. So this is repayment part is reducing the notional according to our contract with the loan giver. So like a bank. Bank gives us the schedule which will constitute of those payments that we will see that every month there will be some reduction of the outstanding notional. So if we just substitute here, you see that we can actually, this QTI is equal to CTI minus ITI. So we can substitute this expression for Q, and this will be the relation of our, let's say, the iteration of our notional in time. We have to also keep in mind that the interest payments, so ITI, does not decrease the mortgage notional. So this is also what we have seen in a case of the bullet mortgage. So interest rate did not, our monthly payments did not reduce the notional. However, we have here the repayments. So the repayments, this is the payment that we will reduce our outstanding notional. This part is not. So this part we pay the interest over our loan. This part will basically contribute to the reduction of the notional for the next period. Okay. And then we have two types of annuity mortgages. We have ordinary annuity when we have a payment at the next period. So if we sign a contract today for the mortgage, our first installment will take place in the next month, let's say. And we also have annuity due. This means that we pay immediately the amount agreed in the contract. So essentially, if you look at it from perspective of pricing, the difference is very small. It is just a matter of summation, whether we sum from 0 or sum from I equal to 1. So this will be from the financial engineering perspective only the difference. However, it is still something to carefully be taken into account. Essential characteristic of the annuity that installments, so this CTI, are fixed. So this means that we set up a mortgage with a client, or we buying a mortgage, and then all these payments that we will have, they are always fixed. So they're fixed through the lifetime of contract. Of course, if we have a scenario where we will also prepay, so in the regular scenario, if we don't do any prepayments, the monthly amounts will be fixed. However, if we prepay, this means we put extra money except for repayments, then the C would need to be adjusted. So this is something to keep in mind. If we do the prepayment, then also this C would need to change. But I will show you in details of that a bit later. The interest rate in the principal parts have to be balanced. So the sum is constant of each payment date. So essentially, we will solve some kind of equation such that C will be chosen, that there will be the amount collected over the lifetime of the mortgage would equal to the outstanding notional, the initial notional that is given to a client. Since we enforce the condition that each payment over the lifetime of the mortgage will be the same, this means that there is some kind of disbalancing takes place, or balancing of repayments and also interest rate payments. So the interest rate and the principal parts have to be balanced so that the sum is constant. This is the main idea of the annuity option. Therefore, both repayments and also interest rate payments will have follow opposite rates. When the notional is progressively paid back, the interest compound on the notional will diminish. So essentially, you can think of we start with the large outstanding notional, we perform our monthly payments, from which we pay for interest rates and also we repay. Then next month, our repayments, so our interest rate payment of the outstanding notional will be slightly less because we already have repaid the notional. So then as we go in time in the annuity mortgage, in time we will repay more. Essentially, we will reduce our notional more and more, because that's basically the whole idea of the balancing here. So we have a constant payments, and then every month, every payment, we have contribution of the interest rates and also repayments. In the experiment, I will show you, this will be very clear that how this balancing takes place. So how this constant payment is chosen, such that there is a balancing between interest rate payments and repayments takes place over the whole lifetime of the contract. So in order to calculate the correct installment amount C, we have to impose the condition that all the discounted future cash flows of the mortgage will equal to the value of the outstanding notional. So if we look at the time, so if we have time horizon here from time t0 and time t, we have a first payment at time t1, time t2, and time t3, and so on. So if we have a first payment of a constant amount C, then this amount has to be discounted to time t0. So the first point we have a C divided by 1 plus our rate, mortgage rate, to power 1. This is our first discounted amount. Then from time t2, so we have a c, also payment at this constant amount. We have to discount to time t0. So the second payment will be c over 1 plus k to power 2, and so on. So then you see actually the whole payments, whole annuity value. So because we have to discount all these future cash flows, also in 20, 30 years and so on, to today, then the value of this annuity will be equal to the summation of from 1 to m of the constant payments. So this is still a unknown amount, discounted with 1 plus k to power ti. So this is essentially this expression here. Since, of course, constant c is constant, we can also change the summation. It starts from 0 to m minus 1. It's kind of handy because we can, this constant is removed. And then we also realize that this summation is just a geometric sum. So we can find this analytical expression for this annuity. So if we use the principle, so use just the formula for geometric sum, and we enforce the condition that the amount of the annuity, the whole payment that we do over the whole lifetime of the annuity mortgage, has to be equal to n0. So from this equation we can find out what is the monthly payment we have to choose, such that actually this condition will be satisfied. So it's a c is equal to, you see, it is a notional, initial notional with a fixed rate that we have in our mortgage. And then we have this, let's say, a little bit adjusted discounting part. So we have discounting here. Actually, it's a progress because it's a minus here. So it's really discounting. It's the, let's say, moving forward in time and 1 minus. So this is the expression for our constant c. And of course, now we have to look at our repayments. So let's go back on our profile of the notional, depending on our choice of C. And also, if we have prepayments, our C will change. Yeah? So if we do any prepayments, so not repayments, which are the part of the contract, but if we decide to give extra money to the mortgage, this basically means that we still have to go back and we have to recalculate all the outstanding payments with a new outstanding notional. So this is something that needs to be taken into account. So whenever you do prepayment, new C has to be found. So this is also what you can think, that if you have extra money and you would like to give to your mortgage, you will immediately see the effect, because next month payment would be already reduced because your notional has reduced. So although maybe you don't have positive interest rate on your savings, by reduction of the notional, your monthly payment will be reduced. So essentially, you are gaining some profit. You have a profit essentially from that. On the other hand, this is also considered to be a cost for a lender of this amount. Okay, so we know that interest rate payments. So if we have our payment C, we can still decompose C, so monthly installments, into two elements: the ones that corresponds to the interest rate part of the outstanding notional, but also of the repayment part, which is also part of this annuity mortgage. And so the interest rate part will be TI is equal to fixed rate times the notional, outstanding notional. And then we also have principal payment, which will be our monthly payment, installment minus the interest rate, which is defined here. So this is our repayment of monthly repayment. And then prepayment amount. So this is actually this extra amount that we would prepay into our mortgage, is that we take the notional from a given time TI. We have to reduce this notional with a repayment, which is part of the contract of the mortgage, because we will prepay, but only after only outstanding notional is relevant there. So we have to subtract the amount, which is the part of the contract that you have to repay. So this means the notional has to be reduced with the repayment part, and then the prepayment will be lambda times the outstanding notional. So in a bullet part, we didn't have a repayment, so this was just 0. So we had only lambda times notional. But in annuity, we also have to extract part that we will reduce our notional by the contract, because we are obliged to reduce the notional every payment. So if we look now at the iteration part for the notional, so notional at the time ti plus 1 is equal to the notional at time ti minus, and then we have repayments that we have to do, and also we add prepayments. So we have to, you see that this notional will be reduced, and then we have repayments that we will reduce our monthly payments, and this has to be this repayments and prepayments. This is the amount that our notional will reduce on a monthly basis. If we don't do any prepayments, we just do only QTI, so only repayment take place. If we do some prepayments, this amount will be of course larger, so the notional will also decrease faster. Okay, and now if we have this QTI plus PTI, we can substitute for QTI. So here we know the QTI is a CTI minus ITI. So this is what we substitute here. And for PTI, we take this expression and we substitute here. And this is the expression we have. And the last step here is that for interest rate payment, we can use this definition. So we always look at the interest rate payment will be fixed rate times the outstanding notional. Here we have lambda, and then we have NTI, and then for Q, we again substitute the definition with a new, of course, with this definition for interest rate payments. So this is essentially the setting. This is the profile, the iteration at which our notional will decrease in time. So you see, we have a few components. We have our monthly payments. We have a part which comes from the fixed amount, fixed rate that we pay on the notional. And also we have the part which comes from the prepayments. So this is this prepayment part. So we have a notional minus monthly payments, and then here minus the strike or the fixed rate of the notional. So this is the formula which shows us how this notional changes in time if we have some prepayment rate lambda. The prepayment rate lambda at any time ti can be also interpreted as the reformulation of the interest rate payment. So this is also what we can do. I like this separation where we just do repayments and prepayments separately. However, we can also reformulate in a slightly different way. So this lambda will be also included in the interest rate part. When mortgager decides to prepay, the installment for the remaining date is rebalanced according to the updated outstanding notional. So this is what I just mentioned, that if we start mortgage with a given schedule of a payment, of a whole payment schedule for the lifetime of the mortgage, if we decide to prepay, this means that amount, the outstanding notional will change. This means that this C, the fixed amount that we will have to pay for the lifetime of the mortgage, will have to be adjusted. So this means that if you prepay, next month you immediately see impact on your monthly payments. Your monthly installments will be accordingly smaller. So this means that our CTI, or the monthly payments, is essentially time dependent, because at every time TI we have to link it to the outstanding notional. So if we would just go back to the previous formula, this is the extension. So we have a NTI, so CTI. We look at what is the outstanding notional at time TI, and then we have also this part with the interest rate. So now let's take a look at some experiments. First, I will just show you the graphs which I have pre-generated, and then we will move also to the Python code where we analyze different profiles of amortization schedules, so the payment schedules, depending on interest rates and also depending on the prepayment rates. So here we have two scenarios. We have a prepayment rate of 0% and also 12%, and we analyze the impact of varying prepayment levels on outstanding notional that will be presented in the figures. Of course, this is the conclusion here, of course, is that what we have seen before in the bullet type of mortgage is that larger the prepayment rate, the greater the reduction we will have on the notional. So this is what we have. So again, as in the bullet case, at every time TI, we have a left bar and a right bar. So the left bar corresponds to the case where we have no prepayments. And the other side, on the right-hand side, we see a part where we have a prepayment. So let's take a look first on the left-hand side bars. So you see that every blue bar has exactly the same amount. So by definition, monthly payments of the whole mortgage, of the annuity mortgage, those amounts will be fixed. And then we have two components. We have a repayment part, so the blue line, the blue bar, and also we have an interest rate part, so the part that we have to pay essentially for the service of having the mortgage. And then in time, you will see that the red bars are decreasing because the notional, because every month we repay. This means that interest rates on the outstanding notional will be smaller, and then the repayment part becomes bigger. So this is this element that I mentioned about the balancing between repayments and also interest rate payments. So, but we choose this constant C such that it's nicely balanced over the lifetime of the contract. And then on the right-hand side, we have impact of prepayments. So of course, prepayment will impact, of course, our monthly payments. So this C will need to be recalculated, and you can see that we start with this amount here, the total amount, and then it's every time, single time, we are reducing this outstanding, the notional is reduced by prepayments. So this will also have impact on our interest rate, because it will be smaller, of course, than if we don't have any prepayments, because we reduce our notional, and also our C will need to be recalibrated. This means also that the whole outstanding amount is reduced with a prepayment. And this is on the right-hand side, we see a profile of the notional, so outstanding notional of your mortgage, depending on different prepayment rates. So, of course, here it is much smoother. It's a smooth transition from initial, this is time T0, we have initial mortgage, and at time Tn, the last payment, we have also 0. So we start with initial, we have 0. So there is a smooth transition. This is, of course, the design of the annuity mortgage, that we slowly repay all the outstanding payment, the notional. So at the end, by construction, we have no outstanding notional. And so this means that there's a smooth transition of by the prepayment rates. In a bullet case, we had very much different profile. So if we prepay a lot, then indeed we reduce our notional significantly. Then there is only smaller jump for the last payments. If we have no prepayments, there is a huge jump because we have to pay everything at one given point. So in annuity is much different. Of course, you see that also here, the magnitude on the of your prepayment on the notional profiles in annuity case is much smaller. If you go back, sorry for a bit fast, it's much smaller than here. Of course, this has to do with the fact that in annuity mortgage, you are repaying also your notional, and this is not the case in a bullet type of mortgage. Okay, so this is the illustration I want to show, and now let's move to Python experiment. Now let's take a look at the Python code. So similarly as we have seen for the bullet option, for the bullet mortgage, we have a function which will generate the schedule, amortization schedule for the whole mortgage. So it is essentially a very similar piece of code. So you can see we still have a matrix, exactly the same entries, so time, notional, prepayments. That's exactly what we have here, except now we also have this notional code, which is the repayment, which takes place by definition for the annuity mortgage. So here, let's take a look what we do, what is the meaning of each individual column. So we start from the back. So each individual payment, it will be the installment CTI. So this is the formula that I have just presented in the slides. Then we have an interest rate payment, which is we look at the notional at the previous time step, and then we multiply with the rate, our K. So it should be K here. And then what we have, so this is the rate of our mortgage. We have a notional, which has to be reduced. So we have a notional, we reduce it with a repayment, and the repayment is QTI, So this means we take installment payments minus ITI, minus the interest rate part, and that's essentially our new outstanding notional. So this is after repayment amount is taken out. Then we have a prepayment. So we take two consecutive notionals, and then we look at the prepayment rates. So it's a prepayment, and we have a notional at what we have at the previous time step minus amount that we have just done here in this after the payment of our repayment from the market. So this is the T3, and T3 is after the repayment takes place. And then finally, the new notional is calculated using all the ingredients we have just calculated. So we have a notional, we have a repayment, and also we have a prepayment, and also interest rate payments. So all those components are put together, and then we have a new notional, which will be in the next iteration, will be also adjusted. So it is it's rather straightforward, but this iteration process, so it goes over the lifetime of the contract. And of course, if we would have there are a few important ingredients. Of course, if we have stochastic, for example, CPR or time dependent, this would also need to be adjusted because the CPR will also be time dependent, and also possibly stochastic. In the course, we will discuss how this CPR can be modeled as a stochastic process in particular. And also, of course, here this is important that if we do prepayment, then our C, so this is here C, every time step it has to be recomputed. So let's take a look. So we start with a case where we have prepayment equal to 0. Let's have it 30-year mortgage. So let's take a look here. So we have a prepayment of 0. We start with a mortgage of $1 million. We have initially, of course, we have this period we don't pay at the first point. So we pay only at the not time T0. We pay only in the first installment, which will be next iteration, next month or next year. Then we have notional is already here. The new notional will be reduced with the installment. You can see that installments. Sorry, maybe you can see here. Let me show this. You see that every installment in this simulation is fixed. So this is by definition. This is our CTI that is fixed in time. And then if we have then prepayment here 0, we prepay, and of course the notional will be always adjusted with the repayment part. So this is notional repayment. This one will need to be subtracted from this amount, and this will be equal to this amount. So essentially, it's an iterative process where we have two ingredients. We have an interest rate payment, and also we have a repayment, such that the installments will be fixed over the lifetime. This is the profile of our notional in time. So it's slowly decaying until 0 on the last payment date. So if we now introduce 10% prepayment rate, we have you see it's a profile slightly changes. Of course, we see this acceleration of the reduction of the notional because we have a constant prepayment rate. So of course, the impact initial is much larger than if you would have a prepayment equal to 0. But here you see that installments are not anymore constant. So this is something interesting. But of course, this has to do with the fact that our notional, we have to pre-compute our installments. Because we prepaid every month, essentially our monthly payment for the remaining of the mortgage every time has to be adjusted. And of course, so this also means that if we do prepayments, we actually significantly reduce our monthly costs. See, this is actually, it's clear here. And until we have the last installment, which is here, 3,404. Oh, this is actually the installment. The last one will be 3,064. But of course, this has to do with the fact that this reduction in installments has to do with the fact that our constant C has to be pre-computed. You can also adjust this code slightly such that, for example, prepayment takes place only at the given date, and then you will see that installments will be actually constant. Then prepayment takes place, and then installments will still be constant for the remaining. And then whenever prepayment takes place, then everything will be recomputed, recalculated for the remaining of the mortgage. But of course, here, because we do prepayment at every date, uh, every month or every year, every unit of time, then this effect of constant is not really visible. But of course, the reason is why I'm doing this, why this is the chosen way, because here we are looking from the perspective of the portfolio management. We are looking at the large portfolio of mortgages, and this would be typically the case. We have a prepayment rate, which is estimated historically, given people's behavior on how they would, when they would prepay their mortgages. The details on how to estimate this prepayment rate, this lambda, this will be discussed in a few minutes, because this is actually the key element here. How to get this prepayment rate? Is it, of course, it's not we cannot see it in the market. This is very much human dependent. How people think when it's worth for them to perform this prepayment and when it's not worth. I already discussed earlier that typically this prepayment intensity is when people have extra money, for example. You can imagine end of year bonus, or for example, when interest rates on your savings account are possibly negative. Then what's the point of keeping your cash on a savings account if we could just repay or prepay our mortgage, and then immediately we will see impact on next monthly payments of our mortgage. So essentially means that every time you prepay, you have less to pay next month for your mortgage. And then this extra you can actually use to buy something or even prepay faster your mortgage. So many people who would like to be financially independent, they target, their objective is to prepay their mortgage or pay back the mortgage as soon as possible, essentially to be free in some sense. And this will be the main takeaway here. So I think the code will be, of course, available. So please play with it and see what kind of, you can extend this function to make a time dependent, for example, CPR, and also to show this blocks of constant payments. And that would be nice also extension for your better understanding how this annuity mortgage works. In the previous block, we have learned how to incorporate a prepayment rate in our amortization schedule, plan of paying back the monthly payments for our mortgage. And as we have seen already, it doesn't really matter what kind of amortization schedule we have. We can always incorporate the prepayment. Of course, then we have to take into account what is the notional impact on our monthly installments. Now we will concentrate on actually the prepayment rate. What are the factors that may influence that coefficient? So this lambda we have considered just to be a constant parameter. We played with a different prepayment rates coefficients, but now, okay, when actually we can, how this coefficient is related to market observable quantities. So now we concentrate in this block on prepayment determinants. What are the factors in the market or in actually in a human's life that may influence that kind of coefficient? And given that, let's say, the incentive of prepayment, how we can estimate the prepayment rate, which actually we incorporate in our model. So there are multiple reasons for prepayment. We already have discussed the, for example, possibility that if your interest rates on savings account is negative, that's possibly a motivation for you to get rid of it, of the mortgage, of the debt that you have. And literature, there's literature about different incentives or factors that may influence people's prepayments is very rich. So I think if you just search online, you will find many different articles. People study different countries because this kind of factors also varies on continent and countries on what incentives, local incentives, for example, could be present to prepay your mortgage sooner or later. The choice of variables, of course, is impacted by the available prepayment data. So we can estimate, we can learn from our portfolio of mortgages. Of course, if our data set is rich enough, if we have enough number of clients, and of course depends, of course, on the perception of a bank, what type of clients bank would like to have. So this could be also a factor. However, clients may have different incentives, but there is one agreement about specific driver that determines the prepayment rate, and it's called refinancing incentive. So you may have in a portfolio of your mortgages many different clients, different features, for example, age, sex, for example, their incomes, etc. But there is one factor which is common, it's called refinancing incentive. And this refinancing incentive is related actually to the quantity that we will see we can link it to the market. So the refinancing incentive is a primary driver in any prepayment model. The refinancing incentive occurs when a borrower observes a lower rate than the rate of his or her mortgage. This means that if you have a mortgage with a certain interest rate, with certain rate, then if a market rate is moved higher or lower, then you may be more likely or less likely to prepay. And this is also what we already mentioned before, especially if you would have negative interest rates on your savings account, then very likely you'll be more willing to prepay your debt sooner than actually later. So essentially, that maybe it's not the most optimal way of managing your portfolio. Mortgage rates are influencing quantities, fluctuating quantities that are quoted by different financial institutions, and they depend on the type of a mortgage, the construct's maturity, and often on the type of a house that is used as a collateral. So you see that there is multiple factors that may affect mortgage rate. So if you are acquiring a mortgage from a bank, you may notice that there are different banks would give you different rate for the mortgage. And that may have to do, for example, with portfolio or current state of the bank's balance sheet, bank's willingness to invest in particular real estates, or for example, even zip codes or the neighborhood where you live. It could be also a factor whether bank would like to buy or lend you the money or not. Of course, this also has to do with the fact that a bank needs to protect itself. So in a case of a default, the bank needs to assess the risk, what is the likelihood of selling the property if you, for example, stop paying your mortgage. And this has to do with the collateral, the quality of the collateral. Of course, every financial institution would like to have the best collateral, so it's the most expensive houses with the lowest mortgage which is given. So for example, if you buy a house and you have your own investment, your own capital to initially to significantly reduce your mortgage, of course, it's much more attractive for the bank to give you such a loan and to give you such a mortgage, because in the case of default, then most of the mortgage has been prepaid or repaid by you. So this means that there's a less risk. And of course, that can also influence the rate that you will receive from the bank for your mortgage. Other well-known drivers include mortgage age, so the age, how long is the mortgage you want to get, the month of the year, so particularly if there's, let's say, Christmas, if people have some extra income, then also you have taxes. So for example, for tax reasons, if you have a tax office which charges you a tax on your wealth, on your capital, then maybe you would like to prepay your mortgage before before you submit your tax forms. And also another coefficient which is important is called burnout. So if the rates went down, up, and down again, it could be that although rates are getting lower, there is a less incentive for people to prepay because they have already prepaid at the lower rate environment. So this could be also if the rates staying for a low, significant amount of time, then indeed that could also have impact. So if you see rates going dramatically down, then people may consider this to be a great opportunity to prepay, because you never know when the rates will go up. However, if the rates will stay at a very low level, then this impact of having low rates may not be really incentive for clients to refinance or prepay their mortgages. So those, of course, those are natural. They have natural explanation, and based on available data. Other variables may also include age of client. So if you are young, you may not will to prepay. For example, you would like to enjoy your life, enjoy your holidays, etc. Housing turnover, default, and bank account amount. So of course, there are multiple different factors. It's not only related to maybe market situation, but also it's really dependent on individuals. So of course, if you like to estimate the prepayment rate, you really need to know your clients. You really need to know, you have to find out what are the factors that if you have a new client coming to your that you are going to issue your mortgage, then you would like to give the profile of a client. Maybe you like to pre-assess what is the probability, what is the prepayment rate you can assign to a client given his particular profile. But this is not the scope of this lecture, but this is a quite rich literature you can find on the subject, and also very fascinating how people profiles would actually give lower or higher prepayment rate. So that's kind of very, very much interesting. The interest rate incentive is one of the reasons to prepay, and this is one of the most pronounced factors. So if the interest rate move up or down, then we see a direct relation with a prepayment rate behavior. A suitable definition for the prepayment incentive is based on two questions. So we have two questions we need to answer before we that will help us to model the prepayment rate and how to link this prepayment rate to the market observable quantities. The first question is, which quantity is a suitable surrogate for the market rate offered at the time t? So which quantity in the market we can relate to the more or less likelihood of having prepayments. This has to be, of course, related for each individual client to his or her particular mortgage rate that he or she has. And the second, how people compare this rate. So if we have a rate available in the market to their own contract. So if they, what kind of measure we need to define, how people would compare. Is it a difference? Is it a ratio or some other relation that people will look at to decide whether they are willing to prepay or not? And there is a market consensus, or actually the literature consensus, of what is the rate that is mostly influencing refinancing incentive. And the most reasonable benchmark for the price of a mortgage is a swap rate. So we have a swap rate at time t, and we have a time t and t. So these are the swap dates between we have a payments of a swap. And the swap that people will typically look at will be matching the maturity and the frequency of the payments of the mortgage, where the spread is added to protect against liquidity risk. So if you would have, so the consensus is that if you have a mortgage for 30 years with a payments of, let's say, 3 months or monthly payments, then the most reasonable approach would be to look at the market rate for a swap corresponding to the configuration of your mortgage. So for example, 30-year swap with monthly frequency of payments. So that will be the reference that you'll be looking at before you decide whether you refinance or not. And also, in fact, banks derive the under-money mortgage rate for new clients by looking at the swap rate, par swap rate. So this means par swap rate is the one we already discussed in the previous lecture. This is the swap rate, which has which essentially equals a rate such that the swap value at inception is equal to 0. So that's typically, let's say, the starting point for the finding out what is the fair value of your mortgage rate. And there is also liquidity risk. So it's not, if you see a swap rate in the market, let's say 3%, however, bank wants to charge you 4%, this means there is some additional factor, it's called liquidity risk factor, that can be associated with, for example, like just presented, particular mortgage type, particular house, probability of default, and also this additional spread is also profit for the bank. Moreover, the spread also takes into account prepayments. So we already have discussed that prepayment, essentially, it's a cost for the bank because bank is already hedging the position when mortgage is issued. So if you are prepaying, essentially you are it causing a cost because you are not only reducing the notional, but also the position is not fully hedged. So the premium that is actually add on the top is liquidity risk, but also there is a profit and also associated risks that you may prepay or you may close your even mortgage sooner than later. So that's basically the relation. So the swap rate is the one that is going to determine whether people are prepaying or not. And so the initial mortgage rate, so this is what we already have defined, is K. So this is a fixed rate mortgage with a fixed payment. Of course, you can also consider a scenario where we have some period of where we have fixed rate mortgage, then we have a floating rate mortgage, but here we concentrate only the fixed rate part, and then the refinancing will be another fixed rate mortgage on the top. So here we concentrate on the fixed rate mortgages in this scenario. And the new mortgage rate, so the one that will be associated with let's say your refinancing strategy, so the rate that you'll be looking at in the market, it will be defined as the kappa. So this is the new mortgage rate that you'll be comparing your old mortgage rate against. It will be equal to the swap rate. And then we have this zeta, which is the liquidity risk coefficient, and also the profit for the bank. So what we are looking at the comparing the K that you have your current mortgage in kappa, which is the possible new mortgage that you could have from the bank. And of course, depending what is the relation between constant K and the K as you could receive from the bank, depending on the relation between the two, you'll be willing to prepay sooner or later. And of course, another thing is that suppose your kappa here it's smaller than K, then you may not want to prepay your mortgage immediately. So there is some kind of rationality element also, which is very important. So people do not always act rationally, meaning that they do not prepay when the incentive is to do so. And the mortgagors may prepay when it's not optimal. So for example, if you have received some amount of money because you won a lottery, for example, you may prepay irrespectively whether rates are low or high. You can just want to get rid of it, of the mortgage, you just want to pay it off. For example, you have some extra savings that you just receive them, you would like to just prepay, you don't want to care about the mortgage anymore. So there are different life circumstances that people are prepaying, even if it's not rational to do so. Or they prepay or they don't prepay, even if it would be rational to do prepayment. So there is some kind of relation between relation of K and kappa, and also whether it's rational to prepay or it's not. So let's summarize, because we also have this second question. So we had the first question is what is the quantity that we need to look into market to decide whether it is what is comparable to our mortgage. So we agree that this will be a swap rate. And the second question is, what is the measure that we have to look at to decide whether people would prepay or won't prepay? And of course, that is related to the rationality of irrationality of clients. So if we have this new mortgage, which will be kappa, then the first, also the approach that we are going to follow in this lecture will be to define the incentive function as a difference between your current mortgage rate and the new mortgage rate that you would receive currently from the bank. So this is kind of natural way of looking at it. So if you see that, for example, new mortgage rate will be significantly lower than your old one, then you'll be willing to refinance your mortgage or prepay your mortgage. There's also another one. You can, for example, look at the ratio of the two, and then depending on the ratio, you could also prepay or not prepay. So, of course, people are not rational, and this is also what we know from life. And the rationality, if, for example, this is the blue line here, so here on the x-axis, we see this epsilon. So this is the measure of whether people would switch or not to switch, or prepay or not to prepay. Because you see that if, for example, we have a K smaller equal to kappa, this is the moment when you would not decide, you would do nothing. So if your current rate would be lower than in the market, then you would typically you'd be not willing to prepay. However, if your new rate would be much significantly lower than your current, then of course you'll be willing to prepay your mortgage or you refinance your mortgage. So this is typically the graph you have. So you have this break point where you would say, okay, every rational person would say everything if the rate is lower, it's a higher or something. Actually, you have to look a little bit slightly different. If you have incentive, there is a moment where you would say there is you would never decide to prepay, or after that moment, it is very optimal to prepay because the incentive function is already in your favor. So, of course, this is the rational behavior, the fully rational, and of course, expected one is that when people don't behave rationally. So, for example, this could be one client which decides to prepay, although it's not optimal. Actually, this is still, so not he prepays although it's not necessary, or he prepays lower rate that would be optimal to do that. So you see that this is basically here the difference between the two expresses the amount of money that it will be optimal for you to prepay, and also the same here. You prepay although it's not optimal to do so. So this would be something that you would expect in the markets. Of course, every dot here would represent a particular client, that mortgager that gets a mortgage. So given the, let's say, large portfolio of mortgages, you'll be able to estimate this type of curve. And of course, in literature, we have multiple curves. We often call this kind of S. So this is S curve. So you see it's S, but it's kind of stretched. So if you would stretch this S to the other side, it is S-shaped curve, which is called sigmoid curve or logistic curve that you also often hear in literature. And this smoothing function mitigates the rationality and allows for non-rational behavior, possibly including a reaction time to the incentive. So, for example, if rates moved fast or slow, then people, before they make their decision, it takes some time. So people often also wait because, for example, they hope that the rates will be lower or much higher, and that also determines whether they would prepay or not prepay. So people behavior is not, of course, not fully rational. People will be to be more incentive for them to prepay depending on the market circumstances, and this is the shape that we typically would have. And here on the x-axis here will be the epsilon, whether we will decide what is the measure between the new rate and your mortgage rate, and depending on epsilon, you would either prepay or not prepay. And of course, in literature, we have many functions, as I just mentioned, for this model. And of course, we will also use this, so this epsilon and also kappa. Those will be factors used to estimate our lambda function, so our prepayment rate. So depending on the market, so we have a few ingredients right now. We have a swap rate. We have a sigmoid function. So we have this incentive function, and those two elements will give us the estimate of the prepayment. This is a function of a swap rate. So this will be discussed in the coming block. It is maybe necessary to mention a few words regarding the incentive function and exactly the interpretation of the S function, sigmoid function. So for that reason, I have prepared a small code in which we extend what we have previously developed, the annuity, the generation of the schedule for the annuity. And here in this part, I'm defining a S-shaped, so logistic function that is representing our incentive. And you will see that depending on our perception, what the incentive is, whether we look at the rate or we are looking at the difference of our old mortgage versus the new mortgage, the shape of a incentive function can slightly vary. And this is quite important to keep that in mind. So let me run this code. And this is there are two graphs here. So the most important part is the x-axis. So we see that here I plotted a swap rate, the new swap rate that you will see in the market. And now let's try to understand what is the meaning of this incentive. So obviously, if our swap rate here it's increasing, and we have fixed our, so in this case, we have fixed our mortgage at 5%, so somewhere here, and our swap rate is increasing, our incentive to do the prepayment is decreasing. And if swap rate goes close to zero or decreasing or even becoming negative, then our incentive may reach the maximum amount. So of course here this maximum amount, you see that's also what is the worst case scenario for the bank's perspective, how many clients would like to repay their mortgages. So this is a case where we have on x-axis we have a swap rate, and we have a comparison with regards to our old rate of the mortgage. And however, often in the slides you see this kind of shape where it's increasing, but then we deal actually with x-axis, which represents our epsilon. And so epsilon, which is the difference of our old mortgage, so K, and swap. So obviously, if swap is increasing, so here is increasing, so then this means that this value will be decreasing. So this becomes more negative. And if swap value was decreasing, then of course our incentive is growing, because then K value, the epsilon becomes larger because K is positive, and this part becomes more negative, then it's increasing. So this is something to keep in mind. So if we have a function which is increasing, then we deal with the difference of our old mortgage minus swap as seen in the market. And if we see the incentive function to be decreasing, then we deal with a swap rate. Mostly we will see this kind of shape, but I would like to just stress that this is a difference. So please keep that in mind, especially if you are implementing the incentive functions, then you have to really take care of this detail. Small detail, but very important.